Welcome to Kognito Key. I'm so thrilled you're here today. We have a vibrant, highly visual explainer lined up for you, unpacking a topic that often confuses so many business owners and commerce students alike: short-term loans. Specifically, we're going to clear the air today and demystify cash credit versus overdrafts. Here's a quick look at our roadmap for today. We'll start with a brief intro to short-term loans, break down what cash credit and overdrafts actually are, compare their key differences, look at their similarities, and wrap it all up. Let's get straight into it. Okay, let's dive right into this. When banks take in deposits, they don't just let that cash sit in a vault gathering dust. After maintaining their required RBI cash reserves, they lend that money out for productive purposes so they can earn interest. And that's exactly how these short-term arrangements keep our economy moving. Moving right along to our first financial contender. So, what exactly is cash credit, or CC as it's commonly called? Think of it like a dedicated drawing account. Banks extend these short-term cash loans to businesses against tangible security to help them meet their daily working capital needs. It's a revolving credit arrangement. Imagine you own a small manufacturing unit. This facility is literally a lifesaver. It gives you instant, flexible funds to, say, buy raw materials when an unexpectedly large order suddenly comes in. And you know what the biggest perk here is? You only pay interest on the money you actually withdraw, not the total limit the bank sanctioned. That is huge. It's fully repayable on demand, and it does require the hypothecation of your stock or book debts. Plus, your withdrawal limits will automatically adjust as your inventory changes. Now, just a quick note. Banks do perform periodic routine checks to make sure these funds are strictly used for business and don't accidentally turn into non-performing assets. All right, let's transition over to our second financial tool, which is a little bit more versatile. An overdraft, or an OD, is a short-term credit facility granted specifically to current account holders. Basically, it allows a customer to withdraw excess money, going over and above their actual available cash balance, up to a sanctioned limit. Simply put, the bank actually permits you to debit your current account below zero. And for the accounting students watching us today, just a quick reminder, an overdraft always sits right there on the liability side of a balance sheet. Now, there are two main types of overdrafts you should know about. First, there's a clean overdraft. This is entirely unsecured. It relies heavily on your average bank balance and your credit history, making it absolutely perfect for a quick, fast cash fix. On the flip side, we have a secured overdraft. As the name suggests, this one is backed by your own self-liquidating investments. Think things like a fixed deposit, a life insurance policy, or even shares. Now let's set up the head-to-head comparison between these two seemingly similar banking facilities. So, cash credit versus overdraft. How do they actually differ? I'd really love for you to focus closely here, because understanding this precise distinction is absolutely crucial. Whether you're a commerce student aiming for top marks or a business owner just trying to manage your company's cash flow effectively, this is the core of it. And this brilliantly illustrates exactly what we're talking about. Let's walk through it systematically. Look at availability. Cash credit is strictly for business operations only, while an overdraft can be used by both individuals and businesses. Cash credit is a revolving credit arrangement opened in a dedicated CC account, and it's backed by your physical inventory. An overdraft, on the other hand, is a non-revolving setup directly linked to your existing current account. Because of that heavy, tangible inventory backing, cash credit generally enjoys a lower interest rate, whereas an unsecured overdraft is going to cost you just a bit more. And here is a crucial rule of thumb to keep in mind: 50 to 60%. For cash credit, banks generally cap your maximum borrowing limit at a strict 50 to 60% of the total value of your inventory and receivables. So, how do the repayment timelines compare? Well, cash credit facilities are typically offered for a period of up to 1 year. An unsecured overdraft, however, is a much shorter-term fix. We're talking repayment within just 1 week to 1 month. A secured overdraft? That's simply tied to the length of whatever security you provided, like the duration of your fixed deposit. Now, despite all these stark differences, these two tools actually share some common ground. And this common ground can sometimes confuse borrowers. Let's clear that up. Both of these are lines of credit, both are repayable on demand, and both have strict maximum withdrawal limits specified by the bank. But let me reiterate the most fantastic cost-saving similarity here. In both arrangements, you smartly only pay interest on the money you actually use, not on the total sanctioned limit. That makes both of these options incredibly cost-effective if managed well. All right, let's bring this explainer to a concise, actionable close. Ultimately, Cash Credit is your definitive go-to tool for dedicated, ongoing business inventory needs. Overdrafts, meanwhile, provide a versatile, quick fix right from your current account for both individuals and businesses alike. So the real question is, which tool fits your specific financial needs today? I hope this explainer brought you absolute clarity on the topic. If you loved this colorful breakdown, please do subscribe to the Kognito Key channel, hit that like button, and share this explainer with your friends and colleagues. Thank you so much for learning with us, and we'll see you next time.